Hello, and welcome to Own Your Retirement. My name is Albert Lalonde, Kaizen Financial. If you'd like more information about what you hear during our show today, give us a call at 586-752-7008 and visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizen. And while on my webpage, click on my podcast tab and check out my past shows and subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. Okay, so tax season doesn't usually top anyone's list of favorite times of the year. But for some retirees, filing taxes this year may come with a little less stress thanks to a new senior tax deduction that was introduced in President Trump's recent legislation, sometimes referred as the big, beautiful bill. Now, whenever something new shows up in the tax code, it tends to generate a lot of attention, and understandably so. If you're retired or let's say we're approaching retirement, you want to know whether a change like this could potentially reduce what you owe or increase what you're able to keep. But as always, the key is understanding the detail. So today, we're going to walk through four important things you'll want to understand if you're considering taking advantage of the senior deduction as you prepare to file your taxes this year. Now, much of your information for this conversation comes from a recent USA Today article that's headlined Four Things Retirees Need to Know About the New Senior Tax Deduction. And to help keep today's show both, let's say, informative and fun, as always, I'm joined by my co-host, Tony Shore. How we doing, Tony? I know you love taxes, don't you?
Nobody loves taxes, but what I do love, Albert, is when you talk to us about how to minimize that tax burden. But you said informative and fun. I'll take fun. Hopefully I add some fun to the show. You're the informative. I'm the fun. Let's divide up the responsibilities for the show that way. Yeah. Well, I'm still riding on a high from the USA hockey victory, both men's and women's in overtime, beating Canada. My wife and I watched that. We got up early this last Sunday to watch the men's game.
Nice.
That was a great hockey game.
That was a great game.
And the U.S. did pretty well. My wife and I love watching the Winter Olympics. So that was fun. But now we're in a lull. You know, I'm a big football fan, and there's not really any sports that I'm into now for a while yet. So there's that. But I'm doing good. How about you, Albert? You've been busy, haven't you?
Yes. Busy, but good stuff. Same thing like you. A big fan of Winter Olympics. Definitely. We watched that hockey game too. Oh, big. Well, Detroit, we're big for our hockey. So, Red Wings still in the mix there. We got Pistons, number one. I mean, they're basketball.
Yeah, basketball. Wow. Wow.
So we don't have underlying teams right now in this low seed. We actually have teams that are competing.
You have hockey and basketball. Yes. I mean, we have the Wild, not bad. We have a pretty good hockey team here in Minnesota.
And then we have Michigan, University of Michigan in the top, now probably top three after a loss to Duke, but that was a heck of a game there. So a lot of good stuff happening, but
there you go.
More stuff that's happening is this tax stuff. That's the big thing. And we need to learn what's going on here and how it helps them.
Well, yeah, for sure. And I think the new tax deduction, when people hear that, they probably think a lot of people assume, oh, it's a huge break and I'm going to get more money back, which isn't the case necessarily. Or they assume it's so complicated, they'll never fully understand it. So let's talk about things like who qualifies and how much it actually will matter and how it fits into your overall retirement.
Big time. No, it's a great topic because it's not a thing that's there permanently, and that's the thing, and it doesn't hit everybody. So let's kick things off with the most important question: who actually qualifies for this new senior tax deduction? But because before we talk, let's say about how it works or how it might help, we need to understand who it applies to first. So under the current rule, you can claim this new senior deduction if you were age 65 or older at the end of 2025 last year. That age requirement is the first threshold. So you have to be at least 65 and older as of last year, end of 2025. Now, beyond the age, there are a couple of additional requirements. You must provide your Social Security number on your tax return. And you must fall within certain income limits based on your modified adjusted gross income, which is often referred to as MAGI. And then for an individual filer, that income limit is only $75,000 or less. And for a married couple filing jointly, it's $150,000 or less. Now, if your MAGI falls within those limits, you may be eligible to claim the full new senior deduction. Now, if your income is above those thresholds, then that doesn't actually mean you're excluded entirely. You may still qualify for a reduced deduction, or in some cases, you may not qualify for this new deduction at all. Now, however, and this is the important part, even if your income exceeds those limits, you can still claim the senior tax deduction that was in place before this new legislation passed. So this isn't an all or nothing situation, but eligibility does depend heavily on age and the income.
Yeah, that's good to know. And I'm glad you clarified that, Albert, because when people hear income limit, they sometimes assume it's a hard cutoff, like you're either fully in or fully out. And it's not exactly that way.
Yes, like a tax cliff in a sense.
Yeah.
But tax rules are really that simple, unfortunately, Tony. And that's why it's so important not to rely on headlines or even quick summaries. Your specific income level, your filing status, and even how your income is structured can all influence whether you qualify for, let's say, the full deduction, a reduced amount, or just the existing senior deduction that was already available. And this is where planning becomes important because modified adjusted gross income isn't always the same as what people casually think of as their income. It's a specific calculation used for tax purposes. So when I sit down with clients, we don't just look at one number in isolation. We look at the full picture, including how income sources interact, where adjustments come from, and whether there are opportunities to be intentional about how income is reported.
Yeah, and to me, this is one of those moments where understanding the mechanics of the situation, it really matters, doesn't it?
It does. It really does, especially in retirement, where income can come from several places. And the way those pieces fit together can affect not only deductions like this one, but your overall tax strategy.
Yeah. Well, and there you go. And so now that we understand who qualifies, right? I think the next question people are probably wondering is how much is this actually worth to them?
Well, that's probably where most people's minds go next. The new senior deduction is actually worth up to $6,000 for an individual or up to $12,000 for married couples. But in order for a married couple to claim that $12,000 amount, they must file jointly. Now, it's also important to remember that this is a tax deduction and not a tax credit. And that distinction matters. A deduction reduces your taxable income. It doesn't reduce your tax bill dollar for dollar the way a credit would. Instead, it lowers the amount of income that is subject to tax. So I'll give you an example here. If you're a single filer with, let's say, a taxable income of $60,000 before applying this new deduction, and you qualify for the full $6,000 amount, your taxable income would drop to $54,000 after the deduction is applied. Now, that lower taxable income could potentially result in a lower overall tax liability. And for some seniors, that may translate into a larger refund, depending on how much was withheld or paid throughout the year.
Yeah, and I'm glad you talked about the difference between a deduction, a tax deduction, like the standard deduction, and now this additional senior deduction, and the difference between that and a tax credit, because it's one of those things that people get mixed up all the time. I think people hear, oh, $6,000 per person and assume they're going to get that back. Like, I'm going to get a check for $6,000.
Right.
But they're not. But it's still awesome. I mean, it's still a huge standard addition to the standard deduction.
Yep. And you hit it right there. And that's a common misunderstanding there, Tony. The way I want people to actually really understand, think of it like a coupon at the grocery store is your deduction. So you get a deduction off the price, but at the register, the credit comes off the final bill. So this is a deduction, not a credit. And the $6,000 or $12,000 for married couples finally jointly is the amount that reduces taxable income. And the actual tax savings depends on your specific tax bracket and overall situation. So that's why it's so important not to assume what the outcome will be without running the numbers. And for some retirees, this deduction may meaningfully reduce what they owe. And then for others, the impact may be, let's say, more modest. But either way, it's something worth understanding and factoring into your broader tax planning conversation.
Yeah, and it isn't necessarily life-changing money for everybody out there,
Mhm.
but for some, it's going to have a big impact, and it's also not something you wanna overlook.
Yep. In fact, that's a
Yeah.
great way to put it there, Tony. You have to remember in retirement, even incremental improvements in efficiency can add up over time. And when we're building, let's say, a long term income strategy, we look at every opportunity to manage taxable income thoughtfully, especially when new provisions like this become available for you.
Well, and here's something that I think, surprises people when they hear about this deduction, this extra $6,000 per person or 12,000 per couple, it's not a permanent, deduction, is it?
Right. Bingo. And this is a critical detail. The legislation that introduced this new senior deduction only created for tax years 2025 through 2028. As of now, it's temporary. Now, I've already seen some other legislation, other representatives trying to push this into permanent, but we'll see how that goes. But right now, it's temporary, and we simply don't know what will happen after that window closes. Future legislation could make it permanent, like I said, but lawmakers could choose to extend it for, let's say, just another set period of time, or it could be allowed to expire altogether. At this point, Tony, it's hard to say. It's uncertain.
So, basically, this isn't something retirees should automatically build into their long-term plan as a forever benefit then?
Yes. Whenever we're dealing with temporary tax provisions, the key word is flexibility. If you qualify and it's available, it may provide some relief during those eligible years, but it's important not to assume it will always be there. And that's where thoughtful strategizing comes in. Now, when I work with my clients, we don't just look at this year in isolation. We look at how today's taxes environment fits into longer term retirement income strategy. If a deduction like this, let's say, is available for several years, we account for it in our plan, but we also stress test the plan under the assumption that it may not continue beyond its scheduled time frame.
Yeah. Well, and I think it comes down to planning for both possibilities. Now,
Yes.
before we move on, let's take a moment here because a lot of people probably have questions like, how does this apply to me? What are the
Mhm.
benefits here? What type of tax planning? Because it is effective from last year. They made it retroactive. So when you turn
Yes.
in your taxes here, this is tax season. You want to take advantage of it. So if people have questions,
Of course.
how can they get a hold of you?
Yeah, folks, if you have concerns or questions about this new Big Beautiful Bill Act, just give us a call, 586-752-7008, or visit us online at www.kaizenfinancialinc.com, Kaizen, Kaizen. Scheduling takes only minutes, and we're always happy to work with your schedule. And like I said, the more you know and putting these numbers together, the better you'll understand what your retirement future looks like.
Yeah, and you want to be working with a trusted financial services professional like yourself, Albert, and ask questions. There, it's a no charge, no obligation consultation. Now, what do you have for us next?
All right. Well, earlier in the show, we focused on tax issues that matter for people who are already retired,
Sure,
like the new senior tax deduction and how it works. Now, Tony, let's shift gears a bit and talk about people who are nearing retirement.
sure.
There's some great details in a Fidelity article with the headline titled In or Near Retirement, 7 High Impact Money Moves for 2026. Now, these are practical actions that can actually help shape your financial security, not just this year, but into your retirement years.
Yeah. Yeah. And I know this is something you like to talk about and help your clients with. So, what's the first move that you're recommending,
All
Albert?
right. So the first move involves something that may sound simple, and that's revisiting whether you should itemize deductions on your tax return. Now, I know in recent years, many people have defaulted to taking the standard deduction, but depending on your situation, especially if you're in the higher tax states or have meaningful deductible expenses, itemizing may still make sense. This is particularly relevant for people nearing retirement who may still have mortgage interest, let's say charitable contributions, or even significant state and local taxes.
So this isn't just about running on autopilot then.
Right. No, no, no.
Yeah.
Tax law changes, personal situations change, income levels change, and what worked for you, let's say 3 years ago, may not be optimal today. So sometimes the difference isn't dramatic, but sometimes it is. And in the years leading up to retirement, every opportunity to manage taxable income thoughtfully, well, it does matter.
Yeah. Okay, how about move 2? What else do we need to know
All right.
here?
The second move ties back to what we discussed earlier, the new senior deduction. If you're 65 or older, even if you're still working or just easing into retirement, understanding how this deduction interacts with your broader tax strategy is important. The key point here is coordination. It's just not about claiming one deduction. It's about understanding how deductions, income sources, and withdrawal strategies all fit together.
So in the end, somebody might technically qualify if they're 65 or older, even if they're still working. But the bigger question is then how does it fit into their overall picture, right?
Exactly. In fact, retirement planning, Tony, isn't about isolated decisions. It's about alignment.
Yeah, good point. All right. Well, we can't talk about taxes or money moves without talking about Roths.
Yes.
I know you like to talk about Roths, Albert. Roth conversions specifically. What can you tell us about Roth conversions? What do we need to know? That's a big money move right there.
Big time. In fact, a Roth conversion involves obviously moving funds from a traditional tax deferred account into a Roth account that's tax free. Now, you pay taxes on the amount converted today, but future qualified withdrawals can be tax free. For someone nearing retirement, this can be particularly powerful during years when income is temporarily lower. For example, if you retire at 63, let's say, but delay Social Security until 67, there may be a window where your taxable income dips. That window can sometimes present an opportunity to convert funds at a much lower tax rate.
Hmm. But this isn't something that you just do casually, right?
Definitely not.
Yeah.
Because once you convert, you can't undo it. So you're choosing to accelerate taxes into the present in exchange for potential tax flexibility in the future. So it requires careful modeling, not guesswork, because Roths certainly aren't a solid fit for every financial strategy. It's essential to discuss them with your financial services professional before any final decisions are made.
Yeah, and the next thing, the next big money move is really at the heart of what you help people do, and that is building a reliable retirement income plan. Tell us about that.
That is right, Tony. We call that mailbox money.
Yeah.
Checks that come in the mail every month. And it presents some intriguing information, actually. Accumulating assets is one challenge. Turning those assets into sustainable income, well, that's another big challenge. As you approach retirement, it becomes critical to answer questions like how much income will you need? Where will it come from? And how will it adjust if markets fluctuate? That may involve coordinating Social Security timing, understanding required minimum distributions or RMDs, and thinking about income sequencing.
Yeah, and really, this is all about that shift from being in a saving mode to a distribution mode, right?
Yes, perfectly stated, Tony. And that shift changes the math too. When you're accumulating, volatility can be uncomfortable, but very manageable. When you're withdrawing, well, big difference. The sequence of returns matters much, much more. And that's why thoughtful income structuring becomes so important in those final working years.
Yeah. And when we're talking about money moves and retirement planning, we have to mention healthcare. What do you have for us there?
Well, healthcare planning becomes increasingly relevant as retirement approaches. And it's not just about Medicare enrollment timelines, although those are important, so keep that in mind. but it's also about understanding how healthcare costs fit into your long term financial projections. Long term care, in particular, can be one of the most significant financial variables in retirement. And you don't necessarily need, let's say, a specific product, but you do need to have a strategy for it.
Well, yeah, because ignoring it isn't going to make it less expensive, right?
That is right. And planning doesn't eliminate risk either, but it does help reduce the uncertainty.
Yeah. Yeah, and well, that's a good point. So, and you've told us on many previous shows, Albert, no financial strategy can completely eliminate all risk, but there are steps you can take to reduce risk, right?
Exactly. Now, another high impact move is stress testing your retirement plan. That means running projections under different assumptions. What if markets underperform? What if tax laws change? What if you retire earlier than expected? A plan that only works in the best case scenario, well, in my honest opinion, isn't really a plan.
Yeah, it's more of a hope at that point, and we hope for the best,
Yeah.
but we need to plan for the worst.
You got it. I completely agree with you, Tony. Stress testing gives you confidence that your strategy can withstand well, let's just say variability, which is going to be inevitable. Life
Yeah,
changes.
yeah, it does. And that brings us to the biggest move people can make. It's so important, and that is working with a financial services professional like yourself, having that coach and quarterback to
Yeah.
help them, right?
That's right. I mean, and it's not because you're incapable of, let's say, managing your own finances, but because retirement planning involves layers, folks: taxes, income strategy, healthcare, estate considerations, and market risk, and all that stuff. Having someone help coordinate those moving parts, like a conductor, let's say, can provide clarity. And let me tell you, clarity can help reduce the anxiety, which means you'll have more fun in your retirement, healthier, and live longer.
Yeah, and reducing anxiety, that's something that everything you've talked about during the show can lead to. And
Yeah.
you've talked about it throughout the show today, right?
Well, if you look at today's episode as a whole, there's a clear theme. In the first half, we discuss a specific tax provision, the new senior deduction, and the importance of understanding its details and temporary nature. In the second half, we broadened the lens. We talked about proactive planning for people who are approaching retirement, revisiting deductions, considering Roth strategies, building income frameworks, planning for their health care, stress testing their projections, and seeking coordinated advice. Look, none of these moves are about chasing trends and headlines. They're about preparation. Retirement isn't a single decision, folks. It's a sequence of decisions. And the more intentional you are in the years leading up to it, oh my gosh, the more flexibility you may have once you get there. So, if you're already retired, it may be time to revisit your tax strategy. If you're approaching retirement, well, it may be time to examine whether your runway is long enough and stable enough. Either way, the goal isn't perfection, folks. It's about having clarity. And as always, if you have questions about how these strategies might apply to your specific situation, that's where personalized guidance matters the most.
Yeah, because headlines and articles are helpful, but your life isn't a headline.
Yeah, that's a great summary. And thoughtful planning today can help you move into retirement with more confidence tomorrow.
Exactly. Well, this has been a great show, an informative show, Albert. Do you have anything else you want to add before we go today?
Folks, if you have questions about your retirement, your financial strategy, how the new tax change is going to affect your future, visit my website at www.kaizenfinancialinc.com, Kaizen, Kaizen, or call my office at 586-752-7008. We'd love to help you protect your savings and feel confident about the road that you're going on in your retirement. And remember, we're helping you so you can own your retirement.
All right. And that's the key right there. Thanks, Albert. Listeners and viewers, thanks for tuning in. That does it for today's episode of Own Your Retirement with our host, Albert Lalonde.
Take care.